Welcome to Accounting 101. Today I would like us to look at concepts relating to companies. So the first concept that we are going to look at is South African Revenue Services, internal auditors, independent auditor, directors and shareholders. So what we are going to do in this lesson, we are going to explain these concepts since we are going to use them later as and when we are preparing financial statements or as and when we are dealing with the users of financial statements. So it's better for us to first explain these role players or concepts, if I may put it that way, so that we are able to use these particular terms or apply these particular terms precisely. So, firstly, you have South African Revenue Services. SARS or South African Revenue Services, we are referring to a government agency that is responsible for collecting different forms or different kinds of taxes from companies and individuals. So whenever we are paying your income tax, whenever you are preparing your financial statement or your income statement as a set or part of annual financial statement, we pay what we call tax or income tax, or rather tax on companies. So we pay it on SARS, South African Revenue Services, which represents government, and therefore we know or we are aware that they are a government agency responsible for collecting such taxes from companies and individuals. But for the purpose of this lesson or of this accounting lesson, we are only going to focus, or our focus is going to be limited to a government agency collecting taxes from companies. Second one is your internal auditors. Internal auditors are not independent auditors. By saying they are not independent auditors, I'm referring to a situation where these particular auditors are employed by the company. It means that they are working for that particular company. As they are working for that company, they are responsible for only one reason when it comes to accounting. They are responsible for implementing sound internal controls, meaning that procedures to safeguard information and to safeguard the finances of the company. They are responsible for such tasks where they implement or they introduce in a company internal control systems that will make sure that information, finance information or financial information or any other form of information is protected within the particular company. Then we have an independent auditors. An independent auditor, you are referring to an external auditor. By external, we are referring to an auditor that is not employed by that particular company, but is called in by the shareholders. So at the end of the financial year, they will call in this external auditor so that this auditor is responsible for analyzing the financial statements in making sure that financial statements given to shareholders as a form of a financial report or an annual financial report indeed paints the right financial picture. It means that these particular financial statements, they are prepared in accordance or in application of a prudent concept. They reflect exactly the financial transactions or the financial movements of that particular company. They are not misleading in such a way that they can be used, or rather they are reliable. They can be used for the purpose of decision making. So these independent auditors, they report to the shareholders. Once they are done with analyzing financial statements, it means that these auditors they will issue out what we call an audit report. An audit report sums up, or rather it's a summary of all the findings that were discovered during the analyzing of financial statement or during the auditing of financial statements. Then you have directors. Directors are employees or senior employees of a company employed or appointed by the shareholders. They are responsible for taking strategic decisions. These directors, they represent, will have a marketing director, a finance director. So all these directors, they are responsible in making sure that whatever plans or whatever decisions that, or other plans that were decided upon or made by the shareholders are indeed implemented. So that is the responsibility of the directors, to make sure that departments are well represented and departments are well performing as per the instructions of the shareholders. Then lastly, we are referring to shareholders, of which is the last concept. Then shareholders, you are looking at the owners of a company. By owners of the company, we are referring to shareholders where these particular shareholders have invested amounts of money as a form of capital, showing interest. Once they have invested that interest, they will expect dividends at the end of the financial year or at a certain period of time. So these shareholders, they own that particular company, and as their form of investment, there will come a time where they will expect a return on their investment. So in short, shareholders are the owners of the company.